Hello, and welcome to the Murray Wealth Group's virtual presentation quarterly update. Thank you so much for joining us today. Our CEO, Bruce Murray, and portfolio management team, Michael Hakes and Jamie Murray, will take us through an inside look at our MWG investment strategy through some of our core stocks in the funds. Our portfolio management team has over 80 years of experience, which span every major cycle since the mid-1970s. The format of this talk will be in 3 sections. First, we will take an in-depth look at the markets. Next, we will move on to discuss our 2 pooled funds, highlighting our investment process for each through selected focus stocks. The final section will be a Q&A led by our advisory board chair, Susan Delhoff, to give you, our audience, an opportunity to ask further questions of our portfolio management team. Please feel free to ask anything about the information you heard today, our current holdings, or any questions you might have about the firm. Without further ado, I'd like to pass it over to our portfolio manager, Jamie Murray, for some opening remarks on the markets.
Hey, thanks, Michaela. So I'm going to be doing the market update for us today. Michaela kind of gave us a nice agenda about what you'll see, but to kick it off, I think market update, everyone, and here we got everyone and their dog is expecting a recession. This is my dog, Coda, and she's there asking, when's the recession coming? I think it's a question that's been on very topical really since April 2022. The market really started to predict or start to price in a recession with the Fed interest rates increasing, as well as the inflation outlook as well. So that's sort of like where we're coming from today, and where the inflation outlook obviously improved a little bit over the last few months. We saw the data, so we'll go through some of that. But the other big reason why everyone thinks that there might be a recession is, well, quite frankly, the leading economic indicators are pointing to a recession. And so these are a set of indicators. You can check it out online. You can Google the conference board and you'll find it. But leading economic indicators have historically predicted recessions. And in this case, it looks like they're pointing to one again. So why are we still constructive on the equity markets? Well, some counterpoints here. We think a lot of this is priced in. As we saw last year, one of the worst years in the last century in the equity markets. So a lot of this recession talk got priced in. Some of, as we talked about, the leading causes being inflation and the central banks raising interest rates. We're starting to see that peak and almost reverse. So inflation looks like it's going to trend lower throughout the year. And this liquidity squeeze we've seen from central banks, we think is coming to an end. As well, we've got China reopening. This is the world's second largest economy. So we'll talk about that. And that's, again, a data point that typically doesn't happen in a recession, in historical recessions that we've looked at. And then as well, there's big supply chain issues, and obviously the commodity spike of early 2022, and those are reversing. And we think that's going to give some margin relief to corporates as we move through this year. And so market overview, why do we say everyone's waiting for the recession? Well, quite frankly, it's being called for by almost every strategist on Wall Street. Here's a chart showing the probability of a recession happening in the next year, going back to 1970s, according to professional economists. And you can see that number is well at an all-time high. And I think the big takeaway here isn't so much that sometimes the economists are right, sometimes they're wrong, but it's more that the expectations of a recession have never been higher than they are today. As well, there's the American Association of Individual Investors, the AAII, and they run a famous Bulls Bear weekly survey for all their members. And that's been a very bearish, or that has trended very bearish over the last 6 months. And even the last reading, 30% of investors were bullish, where historically 37% on average are bullish. And that can trend as high as 50 or 60%. When the market's really feeling a little perky. And so again, going back to this recession being priced in, we were coming out of 2022, one of the worst years in the last century for the equity markets. You can see there the S&P 500 was down 19.2%. And really that's a return that we only really see those type of returns when there's a major financial catastrophe. So the great financial crisis in 2007, 2008. other big down years going back to the Depression or World War II. So these are the type of years that we're comparing or putting 2022 into a bucket. And even though there are some major, catastrophic events like the Ukrainian invasion, nothing on the same scale as what we saw in those other years. So a lot of this repricing, we would argue, has been put into the market. And then where were we today? Well, January was up 6%. It's a good start to the year, and we'll see how the rest of the year shapes up. Speaking as to where the market is today, how did the market get here? It's at the S&P 500 is trading at a level of 4150, give or take a few points on that as it moves around intraday. And so this chart here, it sort of shows you the two indicators that we look at for the market to see where it's trading, and that's the earnings per share, or the earnings for the S&P 500 on aggregate, and then the PE ratio of the S&P 500. And so you can see that blue line there, that's the PE ratio, that's the valuation level. Right now it's trading at 18.4 times the next 12 months earnings. That's a little bit on the higher end of its historical range. Typically it's between 16 and 18 times. And then when you get a big flush out, it can trade below that, as you saw when the COVID lockdown started. And then famously in December 2018, there was a pretty sharp sell-off that quickly reversed. And then likewise in 2020, 2021, when we were emerging from the lockdowns and dealing with COVID, the market was a little bit anticipatory of that strong EPS growth that we saw in 2020 and 2021. And that's the yellow line on that chart. And so you can see the yellow line is kind of topped out around that 225 level. That just sort of shows that the consensus estimates are starting to come down a little bit as economists start to price in some of the slowdown, and analysts start to price in some of the slowdown we're seeing. So what's our view? Well, we think we're in a bit of a seesaw economy where we have some sectors that are hot, some are cold, some are high, some are low. And as we work through this, it's really going to sort of balance out, and it's going to keep us out of a deep recession. And so on the slowdown signals, well, we've got slowing purchasing managers indices and new orders. So slowing industrial activity in some sectors like manufacturing. We're starting to see some cracks in credit. Credit quality is typically, again, another leading indicator that can highlight when there might be some economic weakness coming. And so we'll talk about all these as well. Excess savings. During the pandemic, consumers built up this giant cash buffer when everyone was locked at home. And in 2021, 2022, they've been spending down that cash buffer. So even though inflation has been pinching the wallets a little bit, that excess savings buffer has meant that families can still go on that trip they've been planning on, or to go for dinner, on a special night like maybe tonight, Valentine's Day. We'll think restaurants will be busy because consumers still have that cash buffer that sort of insulates them from any sort of short-term inflation pain. And then as well, we've also seen layoffs, particularly amongst the higher end of the labor market. So think about Google and Meta, two large tech companies, have recently announced layoffs of 10,000 employees, give or take. And each of those employees on average are making about $300,000 in total compensation. So even though at the lower wage part of the job market is still very strong, there could be some economic weakness or consumer slowdown coming from those bigger ticket items or higher income consumers. On the flip side, pickup signals, where are we seeing that might rebound in 2023 and help out the markets? Well, we're seeing improving liquidity, and in this we're talking central bank liquidity. So obviously in 2022, there was the great squeeze where central banks globally started raising interest rates in tandem, pulling back on stimulus. We see that coming to closer to an end than a beginning, and a slower rate of interest rate increases from here. And even just a couple of weeks ago, we saw the Bank of Canada, sounds like it's at least temporarily pausing its interest rate hikes. Obviously, there's been some data points in the last month that means the US is probably going to keep going for another couple of meetings. But considering that they've raised from almost 0% to close to 3.5%, 4%, another couple half percentages here and there, the magnitude of change is going to change and slow. Well, we talked about China reopening, the lower input costs again, which we'll go through, and then jobs. At least there's no shortage of jobs And it's hard for, we would argue it's hard to see a deep recession when, almost everybody who wants a job can get one. The unemployment rate is the lowest since the 1960s in the United States. And so here's the famous LEI chart, the leading economic indicators. Again, this is from the Conference Board. And this chart right here shows you the year-over-year change in economic indicators. And so this is the Conference Board that included the markup on here, so the red lines. But as you can see, when the year-over-year change falls below 4%, typically that's been a warning sign that a recession may be starting or maybe on the way. You can see the last 3 recessions, how that trended. And right now, as of January or December 2022, we're just starting to dip below that 4% line. Now, whether it stops where it is and starts to reverse and heads back up, or continues to fall, we'll have to wait for additional data points, but that shows you where we are today and why the market's starting to be concerned about a recession. And then if you look at the actual components, I've circled a few that we can cover, but we talked about credit. So again, we started to see some cracks in the auto loan market with used car prices coming down and financing rates heading higher as well. We're always hearing about the difficulty in the mortgage market that some are facing with higher mortgage rates. So credit is included here in this leading economic indicator index. The interest rate spread, that's the yield curve. So the yield curve right now is inverted, and historically an inverted yield curve has been another warning sign that a recession may be around the corner. Typically, longer-term interest rates are higher than short-term interest rates. But right now we're seeing the opposite of that, where short-term rates are higher than long-term rates. And that's, again, due to the Fed and other central banks pushing up short-term rates to try to slow the economy. But longer-term, the bond market is pricing in a lower interest rate. And then down below that in the non-financial components, you can kind of group these together, but it's really new orders indexes. So you think when the economy is expanding, you'll see new orders rising. Companies want to grow, they want to add to their inventory base, they want to add to their capital base in anticipation of future growth. So obviously, it's the flip side. When new orders are falling, companies are seeing the opposite of that. So expecting lower sales growth or lower need for inventory, and that has that cyclicality effect and circular effect with the rest of the industry and the business cycle, where one company not ordering that piece of equipment might mean a manufacturer is going to lay off some staff and your unemployment's going to increase, and then flows into spending and so on. So we're starting to see new orders slow down quite dramatically. But we would argue, so as we talked about, last year was a very bad year in the equity markets. October 2022, the S&P 500 was down almost 26% at the bottom. And again, this thought that there's a recession on the way isn't a new thought. We've all been worried about it and thinking about it for almost a year now. And so we would posit that, was October 2022 the bottom? And what do we see at the bottom of equity markets? Well, we know that markets typically bottom 3 to 6 months before GDP. So that would put us a GDP bottoming sometime in March, April, potentially May at the longer end. So we'll see how GDP trends over the next 2-3 months. But as well, other sentiment indicators. So we talked about that AAII Bulls Bears survey. For the last 2 weeks of September, the reading on that was 60% bearish. And now 60% bearish is an extremely high level of bearishness. There's only been 4 other weeks in the 36 years that they've been running the survey where the bearishness was about 60%. And it was, again, going back to times like March 2009, when the market bottomed following the financial crisis. So those types of times where you see that level of bearishness. Again, sharp rallies are common off the lows. We were up 16% on the S&P 500 since October. And as you can see here on this other chart, there's typically a strong equity market rebound off the low. And then one other sort of a counterpoint is, maybe we don't even get a recession. We're seeing strong economic data. And in 1994, there was a similar economic environment where the Fed was increasing interest rates. Economic growth started to slow. The market was widely calling for another recession. The Fed eventually, hit the top of their rate hike cycle, started to cut, and the economy never actually went into recession, and the stock market had another great 4 or 5 years leading up to the 2000 tech bubble. But you had 5 great years following the 1994 bear market. So maybe that's the situation we're in right now. Again, we talked about the liquidity picture and retreating inflation. So this here is a chart of the CPI numbers in the US. We got a new reading today. It was pretty much in line. But and these are RBC capital markets numbers, but we agree with this chart where we think inflation is going to head lower. So not only are we seeing lower commodity prices, auto prices, semiconductors, improved supply chains, all helping the inflation outlook. We're also going to see housing related measures improve through 2023. You can, again, look this up. It's called owner's equivalent rent, but really it's a measure that goes into the CPI that says how much could you rent your house for today to homeowners. And this measure has been running around 7% inflation year over year, but it has a bit of a lagged effect. And that's going to come down because we're seeing house prices in the US are down about 5-10%. So that number, and rents as well, have been falling. So we're going to see that number start to moderate throughout the year. Excluding that measure, inflation in the last 3-4 months has been running closer to that 2 to 3% range. So we think inflation is definitely going to come down from 6%. It was as high as 9% in the summer. Whether it gets back down to 2% in 2024 or just stays a little bit stickier on that 3% range, we definitely think that's an improved outlook over the last year. As well as central banks, we talked about they're starting to hopefully reach the end of that tightening cycle. The Fed's going ahead with their quantitative tightening program where they're letting their bond portfolios mature. So that's one source of tightening that's already priced into the market. As well, the market's still expecting a couple more rate hikes. Again, in the rest of the world, Canada, we're finished with our rate hike cycle, it sounds like, for the time being. And we think the EU and the UK are also close to the finish line. And then across the Pacific, China's actually stimulating the economy right now. So there's a few measures of improving liquidity that we're seeing. As well, the US dollar is one of the best measures of liquidity. We've seen the US dollar depreciate against other global major currencies. And so that's just, again, confirmation that the liquidity picture has improved in the last 3 months. China reopening, it's a boost to global GDP. China's reopening faster than the market anticipated. And this chart here shows you Goldman Sachs's quarterly GDP forecast. And you can see that versus where they were in November 30th, the Q1, Q2 outlook is much improved. They originally thought it was going to be more of a back half weighted recovery, but we're seeing China really roar back. So again, this is just a great boost to global GDP. It's the second largest economy. It's going to help out on the supply chain side because as much as we're trying to decouple from China, it's still a huge source of supply chain issues coming out of China last year. So that's gonna be better. As well, Chinese have a high demand for travel, goods like luxury. So we're going to see the outlook there improve in the first half of the year as well. And even in Canada, Chinese tourists to Canada represent the second largest overseas travelers after Great Britain, I believe. So even companies in Canada should benefit, hotels, airlines, and the like, from China's reopening. We talked about energy being a tailwind to margins. And so these charts here, it's not so much to look at the exact levels, but just seeing that all these different commodities, we have gasoline, crude oil, lumber, natural gas, European natural gas, which is also important for European power prices, and the price of steel are all way down from where they were in the last 6 to 18 months. So they've all peaked out. I mean, you can see gasoline was as high as $4.27 a gallon in the US. As of last week, that was $2.32. And so not only does that help consumers, it helps businesses, it helps shipping, it helps the entire supply chain. And it just represents another source of margin relief that companies are going to have as they either keep those savings for themselves and increase their profits, or they pass them on to consumers or their customers and allow that to flow through to the end product. And then finally, the other big mover in terms of margins, shipping costs. I think we all remember in 2020, 2021, there's huge bottlenecks globally. The ports were jammed up. there was too much product coming in. There was Pelotons stuck on shipping containers for months out at sea. So that's all reversed and unwound in the last 12 months, really. You can see the shipping cost to move a container from a port in China to the US is back down to close to $1,000 for a container. This index here was tracking as high as $5,000 for the same transportation. And the spot market back in late 2021 was as high as, in some cases, $10,000 or $20,000. So to move a container of goods was 20 times more expensive in certain instances versus where it was pre-COVID. And we've seen that normalize. And again, that's going to help improve trade flow, improve companies manage their inventory, and lower the cost for all that. And so I think in conclusion, we think it's time to buy. We think that recession's priced in. We think there's some tailwinds coming in. The sentiment looks like it bottomed in the Q4 of last year. And now we're seeing the market roar back. It doesn't mean that we're going to go back up into the, when the government was stimulating and seeing 25, 30% year-over-year gains in the equity market. But, we're off to a good start this year, up 6%. And we think this could be the new leg of a new bull market. And with that, I'm going to turn it over to Mike.
Hey, thanks, Jamie, for the outlook. And thank you to everyone for joining us on the call today. But for the record, my in-doghouse economist, who is always right, says that a recession is a four-legged word. Bruce and I today are going to talk about the two funds we offer, the Global Growth Fund and the Income Growth Fund. We'll give you a couple of examples of holdings we have in both. And you can see a description of the two funds on this slide. And there are some important similarities and differences. The similarities, which are not on the slide, are that they are concentrated. Each fund holds around 35 securities. So every investment makes a difference. We manage the two portfolios in the same clear and consistent way. And our process and approach has not changed over the last quarter, last year, 3 years, 5 years, and since inception. We take a bottom-up approach to our stock picking, and our company holdings are usually in the portfolio for many, many years. The key differences is the Global Growth Fund gives investors exposure to the world with 75% of our holdings in global stocks, whereas Income Growth is more Canadian focused with 80% in Canadian equities. The Global Growth Fund aims to target companies growing generally faster than the market. They're companies with superior revenue, profitability, and cash flow prospects, and they have management teams with proven track records. The Income Growth Fund applies the same stock picking principles, but to more mature industry leaders, and is more focused on higher dividend yields and dividend growth. For example, you can see the yield differences on the slide here. The Global Growth Fund has a portfolio yield of 1.5%, whereas the Income Growth Fund has a 5.8% yield. You can also see sector exposures on the slide, which are vastly different. Global Growth tends to invest in sectors which are faster growing on a secular basis. And if you add up technology, consumer discretionary, and healthcare today, that would comprise 55% of the portfolio. In Income Growth, those sectors we own, financials, real estate, energy, and pipelines, are generally more mature. And these are higher yielding sectors. And these three sectors comprise 63% of the portfolio. So you can see big differences in how these portfolios are constructed. Global Growth is generally much larger cap than Income Growth. So there's big differences and similarities in the way we manage the two funds, and they are very, very good complements to each other. Before we go into the stock specific examples that I mentioned, I wanted to describe a little bit more about our process and approach, as this will help you to understand our stock examples. As I mentioned, the portfolios are concentrated, holding between 30 and 45 names in the portfolio. And this is a good slide of this. But how do we pick the literally thousands of names out there and put a portfolio together? First of all, we have to manage down the field, because literally there are 5,000 plus names that we could pick and put in the portfolio. So we need a more manageable amount. This is what we call the MWG focus list. And you can think of it as a bullpen of prospective stocks. And there are several ways we get down from that massive list to a more manageable amount. One way that we sometimes use is we cull down the majority of names by using a screening process where we put in some of the key factors that Murray Wealth Group looks at in order to add a name to the portfolio. These include expected revenue growth, margin growth, EPS growth, return on invested capital metrics, balance sheet strength. And this helps us pick up companies with those specific metrics that we're looking for. But this is by no means the end of the process. And quite frankly, most of our ideas come from leveraging our combined team experience of over 80 years. We know the leaders and competitors of each industry and sectors around the world. And this knowledge comes to us from many, many different ways. We attend management meetings, we have conference calls, we go to conferences, both industry conferences and company-specific conferences. We have bus tours, plant visits, we use sell-side broker research. We have analyst calls with those sell-side broker analysts. And you can see on the top left here, within this focus list, of which we have 120 names roughly in our global growth focus list and 70 names in income growth, we place price targets on each of those names, which could be potential candidates for the Global Growth Fund and Income Growth Fund, based on a combination of factors: highest potential return, industry sector leadership, portfolio diversification, and risk management considerations. We build a portfolio. So let's go to right into examples. And you can see the two names I'm going to be using here, Starbucks and United Healthcare. Well, who doesn't know and actually loves Starbucks? Especially a grande iced macchiato with 2 pumps of vanilla syrup, 2 pumps of hazelnut syrup, a shot of espresso, whipped cream, and why not some caramel drizzle. But that doesn't actually make a great stock. Yes, it's a global leader. Yes, it's highly profitable. Yes, highly cash generative and great long-term prospects. But to get into the global growth portfolio and the income growth portfolio, it has to have that one extra thing, and that's a high return to our price target, and it must be attractive. So lots of things are got to align to boot out a name that we currently own with a new name. You can see this on the next slide with a chart of when we bought Starbucks, actually twice over the last 3 years. We bought it first of all in March 2020. That's in the middle of the slide, around $58, as it was showing a very high return in our focus list. Our price target at the time was $100. And if you can remember that slide, so it goes from the left-hand side of the page to the right-hand side of the page. It's now in the portfolio. But as Starbucks, the stock moves higher and higher and higher, as you can see on the chart here, in terms of the stock reacting well to certain catalysts. The price target, which we didn't change from $100, it approaches the price target. So while it's doing great, it's actually becoming less and less price potential, price appreciation. It's actually less and less within the portfolio. So we ended up selling it because we thought it was priced to perfection and it reflected much of that future value. So we sold it at $100. It went back into the focus list, but it was still on our radar. So if you fast forward 1 year from there, where you can see the stock came off, we bought it again in May 2022. And this was after they reported a very tough first quarter. You may remember, even though you try and forget, China was shutting down yet again with COVID. They pulled their guidance completely. That is, Starbucks pulled their guidance. They're having supply chain issues, input costs rising very fast, margins were getting crushed. And to top it off, the CEO was retiring earlier than expected. So all those things crushed Starbucks stock, but we had it on in our focus list, and we stuck by our guns in terms of a long-term view on where we saw Starbucks stock going. So we added again to the portfolio, and you've seen since then it's recovered from those lows. And since we've added it, actually, China has reopened. They've actually announced a new CEO that's coming on, and they've actually, in the interim, they've actually upped their revenue growth targets and margin expectations going forward. So we're very positive on Starbucks, even now in the $100 price range. The next stock I'd like to highlight is United Health. Another good example. For those who aren't familiar with United Health, it's one of the largest healthcare providers in the United States. It offers healthcare benefits, and that's insurance. So insurance to individuals, to small and large businesses. Their other division is called Optum Health, and this spans pharmacy services, surgical care facilities, and healthcare information services. And this is a name, again, we had on the focus list in early 2019. And if you can put it just to the next slide, you can get an idea of how the stock is done. But all that period of time prior to 2019, the return had never been quite high enough to get into the portfolio. It was kind of like one of those names that's always priced to perfection. Management track record was excellent. They had consistent revenue growth, good margin expansion, and consistent EPS growth. But at the time, only really offered a 10% price return to our target price. And it's hard to see on this slide, but it was around that time, it was $270. But if you actually can remember back in 2019, early 2019, Bernie Sanders put himself on the Democratic ballot for president. And there was a lot of rhetoric at that time because he was on the ballot that he was pushing Medicare for all for the US healthcare system. And that put a lot of pressure on a lot of the US healthcare names, including United Health. So what happened was it went from United Health went from $270 down to $220 in about a month or two. And all of a sudden it was showing 40% upside to our price target. And quite frankly, we felt it was very unlikely that the US healthcare system was going to change dramatically as the market was pricing in. So we added to the portfolio at 220. Today it's $500, up around 130%. And you can see we were selling it over the course of the period of that 5-year period, mainly because again, it didn't have that 40% return. Most of that excess return had been captured with the election had been decided, and it was really just going up on its fundamental merits. So we've taken it down over time. It peaked about 3.5%. We've taken it down to 1.5%. We saw other buying opportunities within either funds, companies we owned within the portfolio, or we switched into other names, new names in the portfolio. So that's two great examples of stocks we own in the Global Growth. The next slide will show the characteristics of Global Growth Fund and its active share. The types of companies we buy in the portfolio will show up in certain metrics of the overall fund. And you can see a few of those here. Because our companies in Global Growth generally grow faster than the market, they have less cash flow to pay out as dividends, mainly because they're reinvesting this cash flow back into growth. So do you expect a growth type portfolio to have a lower yield? And you can see that here. Global Growth is showing a 1.5% yield versus 2.4 benchmark. But the other two metrics are actually a little bit more interesting. A growth style would also typically imply that you would have a higher forward PE multiple because you're paying up for higher growth stocks. But in this case, you can see that the portfolio itself is actually lower than the benchmark, 15 times, versus our portfolio today at 13.69 times multiple. But our EPS growth long-term is higher. So you're actually getting more for less, more EPS growth for cheaper valuations. So that's a very interesting metric. And I think one is very attractive for anyone who wants thinking of buying the fund. Active share is also another important concept. Active share measures the percentage of stock holdings and weights in the portfolio that differ from the benchmark. And studies have shown that high active shares are important to a fund's success and performance. Anything around 60% or below active share would be considered closet indexing. And this is not something you want from an active manager. Anything above 80% would put you in the highest of the active rankings. As you can see, Global Growth with an active share of 89% plus scores very highly and supports our active and concentrated approach. Okay, whew, deep breath, eh? So how's the fund done after all that? You can see a snapshot here of the fund performance as of the end of January. You can see from inception, which was June 2015, we have the 5-year number, the 3-year, the 1-year, 6-month, and 1 month. 1 month in this case is the month of January. Our benchmark is weighted 75% towards the MSCI World Index and 25% TSX. And as you can see, great long-term performance over 3, 5, and the inception. And I think that really is a reflection of our good process and approach. The 1 year is a little weak, as it reflects the fastest Fed tightening in recent history and the subsequent sell-off in the market. But as you can see, a good recovery in the last 6 months and 1 month. But that's great. We've done well against our benchmark. But how have we done versus competitors? Let's see on the next slide. Of note, this next slide is as of December 31st, so not January 31st. This is as of year end. But you can see here how we've done also over 7 years. This data has been provided to us by Global Manager Research. And they, in this case, have compiled data on 263 global equity managers in Canada. And they provide their performances. We haven't given everyone's performance. But what they also do is they rank funds by way of what they call quartile. And as I said, I didn't list all the competitors because it would be a lot of pages. So we decided to put in some of the well-known bank funds just to give you a flavor of how we're doing. A number one in that quartile range indicates that you're in the top 25 performers in that group and time period. And this is really where you want to be. But honestly, a second quartile performance is pretty good because you're better than half your competitors. And you can see here how global growth is done over all time periods. And you can see how quartile rankings change over time. You can see that, for example, global growth slipped into third quartile over 1 year, along with our bank competitors who slipped also into third and fourth quartile numbers. But most interestingly is fourth quarter of last year, we had a nice snapback where we put ourselves back into the second quartile, and some of the banks were not as successful as getting back into the top quartile positions. So as I look longer term, those short-term events and their impact will be surpassed by the fund manager's process and approach. So we're actually very happy with what we've seen and been able to deliver. And now over to Bruce to tell you some great things about income growth. Oh, you're on mute, Bruce.
And my dog is telling its pup that the future is golden. Next slide, please, Jamie. So we're going to talk about two stocks here that are in the portfolio. And the first one is Canadian Natural Resources. Canadian Natural Resources has been a great winner, and it went from just being, when we bought it a couple of years ago, an average holding to the largest holding in our portfolio due to the change in market perception of oil and gas producers and Canadian Natural's own incredible superior management. So we bought this stock just in 2021. The dividend at that time was $1.88 a share. And as Mike said, we're focused on dividends in this fund. Now the company's paying $3.80, plus they threw in $1.50 extra. Now we don't expect that to continue, but you know, the 380 is a level that management feels comfortable going forward with. Next slide, please, Jamie. And so here you can see the purchase just back. And let's go back to that time period. ESG was putting pressure on the investment markets, and many big public type pension funds said they would not buy oil and gas because of climate change reasons, and we're trying to discourage it. And then we had the pandemic start in early 2020, and the world said nobody's going to drive to work, and so the stock, Canadian oil prices and Canadian Natural Resources, along with it, plunged. And in fact, in that time period, the derivative trading for oil went negative on one of the closings because there's just people felt there's no demand for oil in the future. And then, surprise, surprise, the pandemic wasn't as well, the situation wasn't as bad as the market was making out. Prices in Canada, especially for CNQ is continuing to, CNQ is the stock symbol, sorry, for Canadian Natural Resources. CNQ was actually doing reasonably well and continuing to increase production and cutting their costs. So we felt comfortable starting to buy the stock as it had an attractive dividend yield. And recently, the stock has got to such a position in our portfolio that we're reducing it. The target price has come down, and but we still we'll be continuing to sell it over the short term to fund other acquisitions in the portfolio. It's still a very great company, though. Next slide, please. Yes, the next stock we're going to talk about is Exchange Income Fund, and this is a company that was relatively unknown. Our first purchase was in June of 2017. At that time, we put our target weighting, we put 3.5% into the portfolio because the dividend yield was 6.4%. And we'll talk about it on the next slide. So Exchange Income Fund, it was underappreciated holding company focused on regional airlines. And the market was looking at, oh, airlines are cyclical. They don't make a lot of money, blah, blah, blah. And but when we got into looking at this is a company, the airlines flew basically out of Winnipeg and other cities to the north. And when you really looked at it, it wasn't a passenger airline taking people on holidays or business trip. It was a lifeline carrying, everything from fuel oil to run the local generating stations, to food, to of course passengers as well. And so it wasn't particularly cyclical. And so we felt comfortable buying the stock with this dividend yield. The management had a strong track record. And then they did something in the start of in May of 2022. This business was closed during the pandemic. They bought a company called Northern Mat and Bridge, and it was the largest acquisition they'd ever made in their history, 5 times the size of some of the airlines they were buying in valuation. And Northern Mat and Bridge is a very boring business. They supply mats and equipment to access remote sites. So an oil well in the muskeg needs mats and things that are strong enough to support trucks. And they caught the oil and gas recovery, and the stock has done very, very well. The dividend growth, when we bought it was $2.10 a year. It's now $2.53, but the yield has gone from 6.5 to 4.7%. It's now below our portfolio. It's gone from a stock that's yielding more than our portfolio to a stock that's slightly below the portfolio. And so the market is now recognizing the quality of this company by increasing its valuation and changing the dividend. Next slide, please, Jamie. We'll talk about the chart. So you can see here our purchases on this stock. Again, we have our target prices, and when the stocks are low, are showing attractive returns on our target price, we buy. And when the stock goes up towards our target price, now because these are income stocks, we're counting on the dividend for most of the money. So we're not getting the volatility we get in the stocks like Mike showed you, where we're trying to generate capital gains. But we are generating capital gains, and so you can see the purchases on here at the bottom points, and we've done some selling at the tops. And we've done nothing at the moment, but we would look at it, and this would be a candidate probably to reduce in the future. So Jamie, next slide, please. So we'll talk about our income growth fund. And again, since inception, we've had a performance better than I would have expected 7 years ago. We expect this fund to yield 6 to 8% on over most of the time. As you can see, our competitors are in that range. But our stock picking, I think, and our discipline has helped us outperform over basically almost all the time periods here. And hopefully we will work hard to make that continue. Jamie, next slide. And so as Mike showed you, we are showing versus our the main retail competitors, which again are big Canadian banks run funds that compete with us on this product. And again, you can see our track record is some of the banks have better track records than they did maybe in the Global Growth Fund, but our track record is totally respectable. And we've done very, very well over most time periods here. And with that, I'll leave it and we'll move on, Jamie. And again, so active share, as Mike talked to you about this, we're 84%. So again, while we're measured by a benchmark, we set a benchmark to monitor ourselves. We really look at the stocks and go for stock picking. You can see again the dividend yield here, 5.9%. Benchmark is 3%, so we're twice that. However, the forward PE is, again, we're lower than the benchmark as we should be, because you can see below the growth rate of our portfolio is expected to be about 6% versus 9% in the benchmark. However, if we make that 6%, we make another 6% dividend yield, we'll be doing extremely well. With that, I'm going to turn it over to Sue, but I just want to make a little announcement, or not announcement, but thank you all for attending our presentation. I hope you enjoyed it. If you know anyone who would like to, our services would benefit, please have them contact us. I'd be delighted to talk to them. And in closing, I wish you all a happy Valentine's Day. And I'm going to turn over to Sue now for questions.
Thank you, Bruce. And thank you to everyone who sent in your questions. We'll try to get through as many as possible in the next, I guess, 15 to 20 minutes. For those of you that do have a hard stop at 3 o'clock, please feel free to leave us them. We understand, and thank you for your participation in today's call. For those of you that can stay on a bit longer, please do. I think the portfolio managers are happy to go on for another 10 minutes or so. With that, I'll get directly to the questions to give you as much time as possible to have the portfolio managers answer them. So the first question I think I'll pose to you, Jamie, is tell me more about Chemtrade Logistics. It seems to be doing very well with a good dividend. If you could answer that, and anybody else who wants to jump in, please do.
Yeah, sure. And I'll put up the portfolios and flip back and forth, and we're happy to answer questions about any company in them. But Chemtrade, you can see here, it's currently the fifth largest holding in the income growth fund. It was the second largest until we pared it back a little bit in recent weeks. But in Chemtrade, I think Bruce and I both talked about it on BNN. It's a commodity chemical company. They produce different types of chemicals in the chlorine and chloralkali. They make water treatment chemicals, sulfuric acid. So just a broad sort of spectrum of industrial chemicals. And we like Chemtrade. So it pays out a high dividend. Its current yield is around 6%. There's a company that had it actually had some legal issues over an acquisition they did in 2015, 2016, and there was big legal bills that they had. So it got into I don't want to say distress, it wasn't distress, but it had some financial liquidity issues back in 2017, 2018. Their end markets were weak then as well. So there's a little bit of pressure on the stock 2, 3, 4 years ago. And then the pandemic obviously, affected all commodity companies. But since coming out of the pandemic, they put in a new management team. The commodity end markets have recovered nicely, and they're actually quite strong right now. And the thing what we've liked about Chemtrade the whole time is they're a low cost producer of their chemicals. So commodity markets being the low cost is very important, because typically the low cost company is the one that wins in the long run. So Chemtrade, so for example, like chloralkali, it's a very electricity intensive process. And so they're based in Manitoba. It was one of their large operations where we have Manitoba has some of the cheapest power. It's all hydropower, so it doesn't fluctuate with the price of natural gas or the like. So low cost operations. And now with the new management team, and they've cleaned up the balance sheet. There's some exciting things going on in the sulfuric acid market, where we're hearing about the onshoring of manufacturing. So in the US and I think Ohio and Arizona, they're starting to build some of these huge ultra high-end semiconductor facilities to build these very high-end computer chips, to put it bluntly, that are all right now made in Taiwan. So the US wants to bring this into the US and be able to make it at home as for mostly security reasons, but to have that ability. And Chemtrade is going to be supplying the sulfuric acid that's used in those operations. So they're building some big expansions, like right next to those sites. So for the first time in 5 years, they finally have some good growth opportunities. The stock still yields 6%. We think they're going to grow their EBITDA number about 30% over the next 2 or 3 years. And it's not as cheap as it was 3, 4, or 5 months ago when it was 30, 40% lower. So we have trimmed it a little bit, but it's one that we continue to hold in a decent weight in the portfolio.
Thanks, Jamie. The next one, Mike, I think I'll pose to you. There were a number of questions asking how you deal with sector and market weightings. 2 in particular, do you pay a lot of attention to sector weightings? And is there any value in trying to steer allocations to match market weightings? And the second one is, in allocating capital, what percentage do you allocate to Europe minus the UK, UK, China, and emerging markets minus China. So Mike, if I could pose those to you, that would be great.
Thanks, Sue. Is everyone comfortable while I go through this? This is a really good question, actually, very good question, because pension funds and large cap funds, they spend a lot of their time thinking about, are we market weight that kind of sector? Are we in, do we have enough weight in Switzerland? What French name should we own? But quite frankly, we generally do not pay much attention to sector weights or geographical allocation, but we are definitely aware of how we are positioned versus our benchmarks. You know, what really drives the stocks we put in our portfolio is our bottom-up stock picking. Every name, as I think I mentioned, we own has a target price and a thesis as to why and how the stock will achieve that target price. But having said all that, we wouldn't go 100% all in tech names or 100% all in staples names. We don't necessarily care if we have, like I said, 0% weight in France or UK or 0% weight in utilities. If a stock isn't showing a good return, we will not put it in. You know, we like to pick companies on their own merits, you know, like long-term growth prospects, technology or product competitive advantage, proven management, not just because they're domiciled in a certain country or placed in a certain sector. We think that companies, you know, company business models transcend geographies and sector placement. You know, for example, we have lots of exposure to China and we don't have a Chinese name in there. We have Starbucks, we got Nike, we got LVMH, we got BMW, who have great prospects in China. I mean, even Manulife has a Chinese insurance exposure. And just as a side note, did you know that Uber is in the industrial sector? We didn't buy Uber because we needed to add industrials to the portfolio. That placement sector, that sector placement makes basically no sense. We bought it because Uber has long-term prospects, its dominant position, and our target price.
Thank you, Mike. Great answer. A third, I own a number of tech stocks, those being AMD, NVIDIA, and Meta, that were brought at much, much higher valuations. What is your short-term, medium-term, and long-term outlook for these tech stocks? And Jamie, perhaps you could take that one.
Yeah, so let me put up the global growth here. So we do own not necessarily all those names mentioned, but we do have pretty good exposure to the tech sector. So we've reduced it slightly in the last 6 months or so. But at one point, the top 4 holdings were all tech names, and you can see really only 2 of the top 10 are directly technology, and that would be Alphabet and Microsoft, who are right now are engaged in a seemingly the start of an epic battle over AI search engine dominancy. But the general thoughts on the tech sector, I mean, obviously 2022 was a very tough year for it. Our last research piece on our website, we touched on this, but there's definitely some frothiness in the sector. And while we believe that our companies were, for the most part, trading at attractive valuations and have dominant competitive advantages, some of the, particularly on the, trying to think, the outside companies of these, some of the smaller startups, some of the venture capital financing, some of that money, even though it wasn't directly invested in, say, Alphabet, they were investing in Alphabet's customers. And so there's a bit of a, Peloton's a good example. Peloton, the share price being, $200 or so 18 months ago, now being a $10 stock. Peloton was able to raise all this money and use this sort of big liquidity draw that they could get when we're in this little tech bubble to advertise, at seemingly infinite, unlimited, place unlimited ads on Google's websites or on Meta, Facebook's properties, Instagram. And so a lot of that business has dried up as the sort of decline in some of these tech companies outside of them has gone on. So we're in a bit of a capital cycle where there's capital coming out of it. Companies are now starting to right-size workforces, cut product development, limit R&D. And so ultimately that's going to slow down the long-term growth rate a little bit while we work through this. But at some point, these companies will be right-sized. They're still very, very profitable. They still have high growth divisions within them that's going to eventually grow through and be bigger parts. So again, going back to Alphabet, one example is their cloud division. It's a company, their division's been losing money for the last 3-4 years as it was building market share, but right now it's about to hit profitability break even, and still growing 35%. And so that's a division that we see contributing meaningfully to Alphabet as we move through. And other opportunities are, like we talked about, AI, so artificial intelligence. Not only the Chat GPT and the cool consumer products that you can build with that will be coming, but there's also a lot of cost optimization and efficiency measures that AI can help companies implement internally and that these companies can sell to their customers. So lots of opportunities still, we think, in the sector, but it is definitely going through a bit of a washout from the activity we saw in 2020, 2021 that might take another 6 to 12 months to fully sort of clear out of the system. Let's see, you're on mute.
I'm so sorry. I don't know how I did that. If I could then maybe move on to Bruce. Under current conditions, would you buy bonds of short duration, less than 2 years, or midterm, for example, 3 to 10 years? And when you buy Canadian bonds or US or both?
Okay, well, thanks for the question. We right now, the only place we would actually use bonds would be in our income growth fund. And the income growth fund is yielding about 5, as you saw, about over 5%. Most of the bonds in the bond market are yielding less than that, which is a little bit strange. That anyhow, and duration of making 3 to 4% is not a range that we feel comfortable with yet in the bond market. We prefer to see probably higher yields that would compete with equities. So no, we're not buying bonds. If a client though requests us to buy bonds, we have been using money market funds and term deposits, which there are some term deposits and from the Canadian banks that have 5% yields, and that is what we're using at the moment. We are not bond specialists though, but I don't think there's a need to be in the short term.
Okay.
Bonds have been the wrong place to be for the last 10 years, and you got virtually zero returns. And then when the market yields rose, the bond long bonds we would have been pushed to if you wanted to get any yield at all, their pricing fell dramatically. I'll leave it at that, Sue. Thank you.
Yeah, thank you. There's another question that just came in here now. How are you managing your currency in the global portfolio? For example, are you investing in US dollars solely and keeping all funds in US dollars?
I can answer that.
Sure.
Our funds have 2 currencies within them. We have Canadian dollars and US dollars. Given the cost of trading, global trading costs are significant to trade. So we only buy stocks that are listed in New York or can be bought in some sort of derivative in New York. There's a whole plethora of global companies available in what are called pink sheets, which are ways of creating ADRs, which stands for American Depository Receipts, which is bringing foreign companies into the US market. And so that's where we do our trading. So we don't need to own other currencies, and we don't make currency calls. The returns on our stocks are higher than the currencies. And so it's not a call we make.
And I think just to jump, I think it's important to point out, so the global equity has a target of 80%. We call it international. It means outside Canada. So 20% Canadian, 80% foreign. And so we'll stick to that range. It might fluctuate if we have some better opportunities in the Canadian market. That's usually driven by our investment, which companies we want to own. And then if we need to do a conversion, we'll do it for that, but not so much actively managing the currency.
Mm-hmm. And just in addition to Jamie's addition is that Canada's about 3% of global equities. And given our clients are Canadian, we have purposely put the Canadian portion of this fund up to accommodate, homeward bias. Number one, we have the opportunity to meet management in Canada more frequently than globally, so we get to know the companies much better. We've got a longer history with them. We understand the culture and things like the Canadian banking system is so strong compared to the global banking system. There's not a significant need to go and invest in US banks or European banks, as the history of these banks is, yes, you can make more money in the short term. They're very volatile, but I think JP Morgan has been bankrupt twice in my lifetime. Citibank's been bankrupt twice, and Bank America, which is still exists, but it disappeared, and a company called Wachovia bought it and bought the remnants of it and took the name. So it's we are focused on higher quality investing, and some areas in Canada provide that.
Okay. I think we have time probably for just two more questions. Should the Fed continue to raise rates to stem inflation, what short and long-term impact will this have on the portfolios? And are you adjusting your models to counteract this potentially negative impact? I know you've spoken to this. You spoke to this earlier, Jamie. Is there anything that you would like to add there?
Yeah, so I think our views on inflation and the Fed clearly, the stimulus that globally, central banks are putting out in 2020, 2021 in response to COVID and keeping interest rates so low that housing prices were, jumping up 20% a year. That was, they were way too loose at that time, and now they're making monetary policy, we think, too tight to almost counteract that action. And it's still creating some dislocations in the market. Like, we believe that a lot of the inflation, especially in some of the more consumer type products, like when used car prices were rising, and now we see those are falling. A lot of those items were transient, and were driven by supply shortages rather than outright demand. So we think that the Fed's kind of indicated they're coming to a point where they're likely going to pause. They're definitely going to slow down the rate hikes. And we think that's appropriate. And, the economy is still staying strong. We saw the job numbers for January were still very, very healthy. There's a tracker called GDP Now that you can, if you Google GDP Now, it's by the Atlanta Federal Reserve Bank, and it tracks real-time GDP, and it's usually fairly accurate. I think it's running around 2% for the first quarter. So economic growth in the US is still healthy. So, I think what the Fed should do is just pause and let interest rates sort of settle and let the market continue to adjust to the higher level, because as we talked about, a lot of it was driven by shortages. And even now, and we're seeing it in Canada too, we still don't have enough housing in Canada, but by increasing the interest rates, we're making it less affordable. We're making it harder to bring on new supply of housing. I think we're seeing similar dynamics in the US too. So I think there's a trade-off in terms of higher interest rates and the supply response available. So there is a bit of a circularity there as well. But yeah, we're probably closer to a rate that should be considered neutral and should allow inflation to remain at a manageable level, but not completely crush the economy. That's, I think, where we're at.
Thank you, Jamie. And just one last question, and I think Mike partially addressed this when he was speaking, but do you invest in India at all? If one buys large cap index ETFs, do you think it's better to favor large cap minus state-owned enterprises, or are you indifferent? So either Bruce or Mike, whoever would like to answer that one.
Go ahead, Mike.
Sure. I would just echo what I said earlier in terms of how we look at our stocks and exposures. And we have all our exposures to the names we own. We don't necessarily have to go into the market, such as India or China. We feel like China specifically is more like the Wild West. They're less regulated. There's always talk about the US delisting all the Chinese names because the accounting practices there are slightly suspect, to say the least. I can say the same thing for India. they still need to come up that curve in terms of reputation.
Thank you. Thank you very much. And thank you to all of our participants in today's call. If you'd like further information, please don't hesitate to reach out to Michaela or any of the portfolio managers. And I join Bruce in wishing you a wonderful Valentine's Day. Thank you, everyone. Bye-bye.